Okay, so we're starting. Like I promised in the last class that this class we're going to look at risk management, and if we have time, we're going to also look at trading plan, right? So remember in our beginner class, I talked about risk management, but I said I I kind of like structured the model for this course to be such that the three pillars of trading, right? Remember, I at the ending of our beginner class, I talked about the triangle of trading, right? At the top of it being strategy, then risk management and psychology, right? So we started with psychology, right? Because that's one of the major things that affects your success in trading. Then we went to strategy, right? So the whole technical analysis, everything we've done on technical analysis was on strategy, right? Getting the strategy. So I've taught you everything in the strategy. Your results now will be dependent on how much time you put into studying the chart, studying the strategy, making sure you execute according to the rules in the strategy. And the final part of the puzzle, which is the risk management, right? So when you combine these three things in the triangle, that's what makes you a profitable, consistent, profitable trader, right? So with the strategy I've provided, you have no excuse. You have no excuse whatsoever. You put in the work. If you roll up your sleeves and put in the work, you will see the results. You'll see the results, no doubt. I can guarantee you that because it's exactly what I'm using, right? That's why I made sure we covered the psychology so that you know the things to look out for, the things to prepare with before you get to the strategy. So today we're looking at risk management. Risk management. What is risk management? To say risk management is a term that applies to any part of business. In any business you have, you can, whatever business you operate, you must have good risk management, whatever, right? I came from the banking sector, so we have a very good risk management department. And even as because I left banking as a client service manager, right? I was managing a brand. So for a brand, you have to have good risk management in managing the assets of the brand, right? And your portfolio to ensure that everything is running well. Because basically in banking, bank is about giving out loans and keeping deposits. So you must manage the risk of keeping deposit and manage the risk of giving out loans, right? So the next, then we say what is risk management? So simply, risk management is how you manage the art of controlling your exposure in the forex market, thus optimizing your profits. This is a skill of protecting your capital from excessive losses in trading. The skill of protecting your capital from excessive losses in trading, right? Remember, I told us that in trading, you will have losses, right? It's part of the business, like every other business, right? So you will have losses, but risk management is the process of managing those losses so that they don't get out of hand, right? Be consistently profitable in the forex market. It is advisable to keep your risk per trade between 0.5 to 2%, right? Some people will say 0.5 to 3%, but me personally, I'll advise not to exceed the 2% mark, right? 2% mark. Even with the prop firms and all these funding companies coming up, they always frown against you going above the 2% mark. But from between 0.5 to 2%, you are guaranteed that you'll be profitable if you manage risk in this way, right? So your risk management gives you a fighting chance, gives you a fighting chance in the markets and determines how long you can stay in the game, right? So, there's a saying that he who fights and runs away lives to fight another day, right? So he who has good risk management lives to trade another day. If you throw away risk management, that's when you end up blowing accounts upon accounts, right? Then you don't have a fighting chance. I can tell you from experience, there were some days in my trading that I was impulsive, right? I took I took more than the losses I was required, right? For my strategy, for my trading plan, I don't take more than 2 losses a day. So once I take 2 losses a day, I'm done for that day, right? Once I take 2 losses, I'm done for the day. So now I've discovered that there was a particular time where I went impulsive on a particular trade. After taking the first loss, instead of reanalyzing and waiting, I just jumped in because I was so sure that trade was going to go. By the time I took my 2 losses for the day, then the opportunity now presented itself, but I couldn't take the trade again. Why? Because I've maxed out my loss for the day. Why? So I will not say I don't have any guarantee whether the next one is going to be a loss. So, and I want to keep a strict risk management. So I missed the opportunity. And unfortunately enough for me, it played out. The opportunity played out, and that opportunity would have recovered my 2 losses and given me extra 3% profit. But I didn't take it. Why? Because I was impulsive and I maxed out on my loss, right? So there are 3 things you need to consider in risk management. 3 things, right? There are more, but 3 primary things we need to consider. Consider your win rate or hit rate, your risk reward ratio, and position sizing. So we're going to be brushing through this. Then we'll go to the charts where I'll show you examples of how you calculate this. All right? Can you guys hear me? If you can hear me, let me just know you guys are on the call and you can hear me loud and clear.
Yes.
Okay.
I can hear you.
Okay. So that being said, we're looking at win rate, risk reward ratio, and position sizing. 3 things to consider in risk management. So win rate just simply win rate determines it talks about the success, right, of your success per trade. This is the number of trades you win, usually in percentage, right? That's the percentage of winning trades out of a total number of trades executed. Example, 50% win rate means you won 5 trades out of 10 trades taken. Or let's say you took 100 trades and 50 trades were winners. Now that you say your win rate is at 50%. This could also mean that 50% of trades taken hits the profit mark, right? So if you say right now that you have a win rate of 50%, it means that if you took 10 trades, 5 were profitable trade and they hit your take profit target, right? Or let's say you took if you have 20% win rate, would mean that out of 8 and 10 trades, only 2 trades were profitable. Only 2 trades were profitable, right? Now, there's a relationship. We're going to be looking at this, and we'll look at the relationship between all the 3 basic elements, things you are looking at, like the win rate, the risk reward ratio, and your lot sizing or position sizing, right? So win rate is also known as hit rate or success rate, right? Some of us, if you go to social media, you see traders bragging about their strategy. Man, my strategy is 75% win rate. My strategy is 80% win rate, right? So what they mean, for people that say 80%, it means that out of 10 trades, 8% are winners. 8% are winners, right? There are several factors that affect the win rate. We are going to look into them, right? By the time we talk about risk reward ratio, I will explain some few factors that really affect the win rate. Personally, I'm not too keen about win rate like risk reward ratio, and you will understand as we go further in the class. Now, risk reward ratio. Risk reward ratio is also known as RRR or RR, right? So the risk reward ratio is a way of accessing potential returns that you stand to make for every unit of risk. For example, if you risk $100 on a trade and expect to make $300 from that trade, your risk reward ratio for that trade is 1:3, right? Or we call it 3R. So you're going for 3R on the trade. So you risk 1% and you're going for 3%, or whatever the percentage you are risking. Even if you risk 0.2%, you're going for what? If you risk 0.5%, you're going for 1.5% take profit target, right? So that's risk reward ratio, right? So in trading, like I said, I don't pay so much attention to win rates. Yes, it's important, but I pay more attention on risk reward ratio, right? Because it determines how fast you get out of losses and the profits you are going to make, right? So a trade is not worth taking. A trade is not worth taking if your risk reward ratio is not above 1:1, right? To have a good chance at profitability, your RR must be above 1:1, right? So that means to me right now, personally, I know there are traders that are profitable by taking 1:1, right? Because they are in and out of the market. Yes, you can do that. That means you have a high win rate. We'll see the relationship very soon, right? So, but me personally, I feel it's a waste of trading opportunity for you to just take a trade and take 1:1. That means you are risking $100 and your take profit is $100. As to me, I feel minimum it should be. I personally advocate for 1:3, 1:3 for a start. Then as you gain experience, you can now increase to 1:4, 1:5. Like currently, I do me, my standard currently is 1:5, and I can go for more. I can go for 1:7, 1:8, but right now my standard is 1:5, right? So if I'm risking 1%, I'm aiming for 5% in profits, right? So win rate is what many people focus on. They want to be right often. Yet risk reward is just as important, right? So people are just so obsessed about being right. You want to be right. You want to out of 10 trades, you want to be correct on 10, but you don't need that to be profitable in the forex market. You don't need to be correct all the time to be profitable in the forex market. Hello, is someone asking a question? Victory, you saying something?
Sorry, I was talking to somebody. Sorry.
Okay. So let's go. So I feel risk reward ratio is more important to me. Yes, it's arguable. Structure will argue it, but to me, I feel risk reward is more important than win rate, right? And you will see there's a chart I'm going to show us in this class, and you understand why I pay more attention to risk reward ratio than to win rate, right? Although win rate is also important, right? RR is how much a trader wins or on winning trades versus how much they lose on a losing trade, right? So when you win big. When you lose small. This is one of the advantage of risk reward ratio. So when you are losing, you lose small, but when you win big. So this helps you even to get out of drawdowns and losing streaks. You get out of losing streaks faster with better risk reward ratio, right? So this is the relationship between risk reward versus win rates. Now, this diagram tells us a lot, right? So this is a chart between your risk reward, the risk to the win rate, right? So let's just say I'm not starting from win rate of 10% because that's just too low. You cannot be profitable with a win rate of 10%. That means you took 10 trades and you won only one. It's very unlikely for you to be profitable based on that, right? Except you are targeting your risk reward ratio of 1:15, which is unlikely, right? So let's say now for 1:1, so if you are a 1:1 trader, you risk 1% or you risk one, let's put dollar value, you risk $50, you are targeting $50. If your win rate is 20%, you can never be profitable. You can never be profitable. The only time you start seeing profitability is when you get your win rate above 60%. And I can tell you for a fact from experience, it's not easy. It's not easy getting your win rate, having win rate above 60%. Currently, I'm sitting currently with my strategy. The strategy I've taught you is sitting at 50% win rate. The strategy I've taught you is a 50% win rate strategy, right? And I'm making money out of it. Sorry. I'm making money out of it to show you that. So if I was taking 1:1 for every trade, I would just be at break even. I will hardly be making any profit. I will need to move my win rate to 60% before I start seeing profitability. right? And also the disadvantage of 1:1 again is that you get to be trading more. You get to be in the market, right? As a day trader, you have to be taking more than one trade, maybe 3 to 5 trades a day or a scalper. Why? Because you're taking 1:1 and looking for the next opportunity, right? Because you take 10 trades, let's say you take 10 trades, one trade per day out of 10 days, and you win only you win only what? You win only 50% of those trades, you just be at break even. You just be at break even. So you must go to 60% win rate before you become profitable. Now, let's look at 1:2, which is a good place to be, right? If 1:3 is too high for you, you want to stick at 1:2. You want to stick at 1:2, right? So for 1:2, you can see on the chart, if you have a 20% win rate, you'll not be making profit. You'll be losing money. If you have 30%, you'll be losing money. By the time you get to 40%, then you start seeing a bit of profitability. You start seeing a bit of profitability in the market on 40%. Sorry, what's happening? You start seeing a bit of profitability at 40% win rate, right? So for this strategy, it's safe to say that if you can also take 1:2 with the strategy I've taught you, and you still be profitable. If you follow this strategy, you still be profitable with 1:2. Then this is what I advocate, 1:3. Can you now see the benefit of risk reward ratio? Once your trade at 1:3, you just need 30% to be profitable. You just need 30% to be profitable, and you are in profit. You are in profit. You don't need high win rates. You don't need the high win rates, right? I tell you, when I started working on the strategy, I was seeing profitability even at 30%. I was passing problem challenges and getting payout at 30% before I moved my win rate to 50%. So with this, you are profitable. You are profitable. So you see 1:4, you see the charts. 1:4, at 20%, you are break even. So by 30%, you are profitable. So this is the benefit. Now, see where, so if you have the experience to execute the way I execute on the strategy for 1:5, just with 20% win rate, you will be withdrawing profits month after month. You'll be consistently profitable, right? You can see I'm at 50%. So this is just a place of profitability with the strategy. So this is why I advocate that for a start, for beginners, before you gain experience in the strategy, you master the strategy, start with 1:3, right? 1:3, right? Don't bother about being right at all time with the win rate. Just start 1:3, and I guarantee you, over time, by the time you practice the strategy, in no time you get to 30% win rate with the strategy, where you will start seeing profit, either from your personal account or from a prop firm account, right? So from there, we'll move to, I just want to rush through this. I will go to the chart. I'll show you how to position stroke lot size and how to do your position, right? Risk management, what you are risking per trade or what you are risking per day, right? So, and I always advise that we stick within the neighborhood of 0.5% per trade to 2% risk per trade, right? So this is simple formula. We're going to see this formula when we get to the chart, and I'll just show you how to calculate your risk, right? It's Maranatha on the call. Okay, I think it's not. It's Maranatha on the call. I remember I asked a question and I said today's class, okay, it's not on the call. Okay, so lot size, this is a simple formula to calculate your position size, your lot size. Remember, we talked about lot size in the beginner class, right? This is the unit of the currency you are purchasing or you are selling. That's what you are executing on. So your lot size now is your account equity times the percentage risk, right? In percent. So if it's 0.5, you put 0.5. If it's 1%, you put 1%. If it's 2%, you put 2%. Or if it's 0.2, you put 0.2. Divide by your stop loss in points. That's your stop loss, right? The stop loss normally is in pips, but you put them in points. I will show you when we get to the chart. Then you divide everything by 100. This will give you exactly your lot size. Now, knowing how to calculate, there there are softwares and that you use to calculate this that makes it very simple. You can use them position size calculators, right? You can go and check them. My what they call them? This this particular people, they have a good position size. Okay, baby pips have a good position size calculator. Then my is it my what do they call this? Okay, if I remember, let you know. But I use that one sometimes.
Calculator.
Your what?
There is one forest calculator.
Yes, there are several types. I'm just saying there are several types that saves you this thing, but I prefer to still know this thing because sometimes, right? Because I'm a scalper and I trade in 1 minute, sometimes the time to go to the forest calculator to go and calculate and come back to the trade has gone and left. So you have to know how to calculate this on the go, right? There's another way. There are also trade managers you can use. That's the perfect one, yeah. Trade managers you can use that can calculate this automatically. So you don't need to even go anywhere. You just click on your execution and automatically it calculates it and puts for you your size and your lot size, which is where everybody's going to. I used to use one, but I think I'm going to get a better one. That one made me lose a lot of account because I will forget to always put the parameters in the trade manager, right? So every time I close my trading platform, it resets instead of keeping the parameters. So most times I just open my trading platform and I just get to trade. I forget that I've not taken the parameters. The risk will be at 7% risk and I'll just execute a trade with 7% risk. It made me lose a lot of money and I blew some challenges because of that. So I just stopped using it, and that's why I just paid attention to calculating it myself, and I do it manually right now. So there are three ways I'm going to be teaching you guys. Three ways I'm going to be teaching you guys how to do this, right? One is by this first formula. Second is your currency quantity, right? Currency quantity divided by the units, both in unit, 10 and 100. I'll explain this, right? So let's say you are buying, when when you put your lot size, it tells you the amount of currency you are buying. Remember in our beginner class, we talked about your standard lots, mini lots being, micro lots being 1,000 units, mini lots being 10,000 units, then standard lot being 100,000 units, right? So that was the quantity, currency quantity. So when you do that, you divide it by the unit. If it's in 100,000, you divide it by 100,000. If it's in 1,000, you divide it by 1,000. If it's in tens, divide by tens to give you exactly your lot size. Then the final one is your amount. This is what I use because this is so simple. Your amount you are risking in dollars divided by stop loss in points. This just gives you straight. So most times I just have my phone. I just hold. I just calculate as the opportunity is playing out. As soon as I set my trading tool, my long or short tool, I just calculate with my phone and I know the lot size and I impute it and I execute the trade. So this is very fast. I use this one, right? So I think we will go straight. Let's stop sharing this. So let's go to the charts and let's look at how all these applies to our trading, right? Let's see the application of how to calculate your risks, right? Today's class is on risk management, so I'll not be focusing already. We know about the strategy. I'll just be going straight to, I'll just show you some few execution, right? So I'll be very fast with breaking down what we are looking into price. Then I'll go down to execution, then I'll show you the risk management, how we calculate it. So you can watch the strategy video. It explains more about the strategy, right? So basically we are going into, let's see what GU played out today for us. Let's see how it played out for us today. So our trading time is normally coming to chart by 1 a.m. So let's see when, okay, by 12. By 12, if we look at structure here, we see that GU was selling, creating lower highs and lower lows, right? Lower highs, lower lows, or selling down. So by the time we open our time, G was going up to create the next lower low, right? So based on the strategy, when we have seen this in structure, we see where we are currently. Now, if we get our fib, so you know that I'm following the strategies, although I'm being very fast, right? Take our fib, we'll see that this lower low came very close, right? So if you see structure and the 50% equilibrium came very close. So it will not be safe for you saying you want to buy at this level when you are just close to equilibrium. And you see that structure is bearish on the 1 hour, structure is also bearish on the 15 minutes, right? So and if you look at from the higher time frame, you see from our last analysis that GU is looking to go down, right? So based on that, by the time we came into trading, let's just mark this point out. Let's go quickly because we're not focused on the strategy, we are focused on risk management. Go to our 1 minute, our 1 minute time frame. Let's very slow. So go to our 1 minute. Let's just go to, okay, let's just focus on, okay, let's go to 2. That's roughly around the time. Network is slow. Please just bear with me. Oh yeah. Okay. So right. So this is where we came out, right? Remember the bias we built from the higher time frame. Said it in the video. So go to the YouTube if you still want to refresh on strategy. Watch the God of Indices strategy 1, video 1 and 2. You understand why I got here, right? So we are so close to this thing. So, and also, if we see here, we see where we came up from. See our liquidity, our launch liquidity. This is the point, right? This is the liquidity. So we are waiting for the liquidity to be run before we execute trade based on the strategy, right? So after our liquidity was run, now this is what price you see. Price gave us a break of market structure to the downside, confirming, right? And price printed what an inversion fair value gap with a fair value gap, right? So this is what, in this case, this is how we place it. Remember, I told us that our stop loss must not be below five pips, right? So you want to get above this high. If you are at this high, probably you'll be taken out, right? So that was 3.9 pips. So just go to 5 pips, you see, you are safe. So that would have been the trade for today. Now, this is where the risk management comes. So they're targeting 1:3. So this is the first method, right? The first method would be to, what's the first method? Do you remember, were we taking notes? That is account equity. So our account equity, let's imagine that our account equity was what, 10,000, right? $10,000 account size. This is the setting of the short tool. This is the setting of the short tool, right? So you see this. We have 10,000 account equity. You are risking 1%, right? So now what you are going to do, you are going to multiply. So for our stop loss, our stop loss is 5 pips. Sorry, it's 5 pips. Now what does it mean? It means that in points, 5 pips is 50 points. Do we understand? That's why I say stop loss in points. So what you are doing, you are doing the first formula. Who can tell us account equity times risk in percentage, right? Guys, are you guys with me?
Yeah.
So times risk in percentage, which is 1%. Let's imagine you are risking 1%, right? What?
Yes.
That's that divide by what? Stop loss in points.
Stop
So
loss in points.
Stop loss in points is what? 50. Because it's
50.
5 pips, so that's 50. The point is 50 points, right? That's you get 200 now. So divide by 100. So our lot size will be 2. So on this trade, you use lot size of 2 to execute this trade. Can you see our 1:3 was hit in no time, and you hit your profit for today if you took this trade today, right? So now let's use the second method. The second method, what's the second method? You can be sure you are following. The second method is what? Guys, can you help me out? Is the quantity, right? The quantity divided by, okay, you are not taking notes, so you are looking at the slide. So the second method is the quantity. We are looking at the quantity you are risking divided by the units, tens, or hundreds. That's the second method, right? So this is how we know. This is how we use TradingView to know how much quantity, how much units of this for this 5 pips stop loss. What's the unit? You go to your settings here on your short tool. Once you go to settings, come down here. You make sure you set everything. You are risking what? 1%. You are risking 1%. Your stop loss is set. So make sure you put the percentage. That's what is more important. You're risking 1%. You are risking 0.5, you put 0.5. You click. Then you come to this. Can you see? It shows quantity. Can you see this quantity here? Guys, can we see it? What's the quantity? 200,000, right? Oh,
Yes, sir.
yes, 200,000. So that's the quantity. So what's the second formula? It's quantity divided by either the unit, tens, or 100. So 200,000, what is it? It's in hundreds, right?
Yes.
So simply what it means that you divide 200,000 units divide by 100,000, right? Because it's in 100,000s. It's not in 10,000s. It's not in 1,000s. 200,000 is 100,000. So if you divide it, see, this is a shortcut, an easy way. Once you divide it, what does it give you? It's still the same thing, 2 lot size, right? That's the second method. Are we following?
Yeah.
Yes.
Yeah, so now the third method, which is the simplest method I like to use. So you just tell yourself, you don't need to know the percentage. Just tell, if you are that kind of trader that you prefer to be risking in dollars. So you just say, I want to risk $100 for this trade. What are you going to do? You just divide $100 divided by points, stop loss in points, which is 50. It still gives you 2. So these are the 2 fast ways. So if you don't want to use position size calculators, these are the fast ways you can use to calculate, right? Your risk price, right? So you see the way I use the short tool on TradingView, that's how you use it to know your quantity. If you want to use the second method, or you want to use my first method, you just go straight. Since you are trading GU, you don't need to bother about it quick with other, almost the same thing. Even if it's gold, even if it's NAS, just look at the stop loss in points and just divide the amount you are risking in dollars by that, and use the same thing in all the formulas. It applies for all the formulas that I've given you. So whatever one you want to use. And if you are so that you know that you can speed up, you can go to the position size calculator quickly and calculate your position and come back. That is also good because we have many of them. We have baby pips. I'll say again, we have baby pips. We have my Forex calculator. There's one I use. Can we guys see my screen? Okay, yeah. Okay, my Forex book, my FX book, position size calculator. So this one I see it does everything for you automatically. So you can put the pair you are trading is GU, right? So let's use the case of we are trading GU. Where's GU? Have I passed it? Okay. So what's your account size? You put your account size. Let's say I'm trading 1,000. Let's say it's 10,000 for the example. We use $10,000 account, right? So $10,000, right? So I want to risk 1%. I put 1%. You can swap between money. So if you want to put in dollars, you can swap here. You swap and you put the dollars. So what's the stop loss? You put 5. So this one you put it in pips. See, they say stop loss in pips, not in points. Then you just say calculate. And you see it gave us the same thing, 2 lots. They are using 2 lots for the trade. So whichever one you choose to use, this is risk management. But what is more important is that you stay in the confines of the risk per trade, right? So having a good risk management shows that you have great discipline. You have brick wall discipline, not plastic discipline. You stick to that. You have to tell yourself the amount of the risks you are taking per day or the risks you are taking per trade, right? So for beginners, I'll always advise that, okay, you can break you can start with 0.5, right? I always, for precision, I always advise that people start with taking one trade per day, risking 0.5% per day. So if you mix, so that will make you very diligent to study your price action, because you know that execution, you just have one opportunity at the market, right? And it will make you, anytime when you execute and you did a wrong execution, you go and learn what made that execution wrong. That's how you improve. That's how I improved in my training. For every stop loss I took, I'll go and study why did price take me out before going. If I was right in direction, why was my stop loss taken out before price movement? So in studying that, it made me become better. And that's what, studying all these things, that's what gave me these entry models that I'm using currently for my strategy, right? So guys, do you have any questions? So right now in risk management, our next class, we're going to talk about trading plan. That's our final class for this class. That's the final class we're going to be having. So we'll talk about your trading plan, when you can have some money management, where you can take partials. I know someone asked me about taking partials, right? So if you have 1:3, I advise you to start with 1:3, right? But I advise you to start with, don't think about partial yet. Just start hard, either stop loss or take profit. Or you can also have a risk management such that you put your stop loss. Once trade goes 1:2, once your trade is at 1:2, you move your stop loss to break even, so that if the trade reverses, you do not lose, you do not gain money. But this will make you not enjoy the strategy quick. So our advice for our strategy, stick to it, just 1:3. Either stop loss or take profit. No break evens, no taking of partials. Do we have any questions? Hello, guys.
No, sir.
Do you have any questions? So this is risk management. So now, what makes your risk management valid is the discipline you have to following it, right? These things are easier said than done. You have to have the brick wall. That's why I say brick wall discipline, to stick to this thing, no matter come rain, come sunshine. Once you set your risk management, stick to it and follow it, right? So in our next class, maybe if you have some other things, because the next class is going to be short. It's just a trading plan, very brief. I'll tell you about trade. So this is basically all risk management is all about. This is risk management. So your result out of it is your discipline to following it. And I've given you the advice, stick to 1:3. And I've showed you the chart on why 1:3 is more profitable for you for now. Right? So our class is going to, we have the 45 minutes, so we'll have less than 1 minute. So the class is going to end pretty soon. So we can call this, if there are no questions, we can call this.